Hello, everybody. Welcome to the Business Backbone, What Every Small and Mid-Sized Business Needs to Get Right webinar. I will be your host for the next hour. Thank you to everyone from SCORE. Appreciate the opportunity. I love these types of discussions. My name is Matthew Bolowitz. I'm a partner at the Koza Law Group, and it truly is a pleasure and honor to be here. So thank you very much to everyone over at SCORE. Before we get started, the real purpose behind this, the business backbone, we've done many series on this type of topic. And it's all born out of the idea that this world is truly built on the shoulders of entrepreneurs. So if we take the time out, help them, support them, lift them up, it's like the rising tide theory. It raises all boats. So very excited to do this. We've done very similar ones like the Start Smart series. So excited to get into this one. By way of an introduction, I've already let you know I'm Matt Bolowitz, partner at the Koza Law Group. There's a lot of words here, but suffice it to say that we are a boutique business law firm. Primarily, all of our clients are business owners. Our main mission is to provide peace of mind. I think attorneys have gotten a bad rap, rightfully so, but we're trying to flip that back onto its head the correct way. And our true mission is to be providing peace of mind for our clients. For myself in particular, I was an accountant in my previous life, switched over to the legal side of things, the legal industry, stayed again in the business and corporate realm. That has then went all the way to a certified exit planning advisor. So what I'm passionate about is right in the description there, helping companies grow, protect their assets, and eventually exit successfully. So we'll get into all of that in just a moment, but that's a little bit about what we are. There's another very exciting piece that I like to do. It's called the Barrows and Bylaws podcast. It's just me sitting down with entrepreneurs and talking about the things that aren't on social media, talking about what was that moment that made you switch and become an entrepreneur. It's exciting conversations. And then what's some of the dark side? What are some of the issues that you've run into? So I encourage you, that would be a huge appreciation on my end. Go check that out. It is a lot of fun. So let's get into it. What is the goal and the agenda for this webinar? I've sat through enough of them where folks are sleeping by minute 5. Hopefully I haven't lost you yet, but what my goal is here today is not a cure-all or to overwhelm you with information. What I want to do is be able to provide you with enough legal, maybe structural ideas and thoughts to put on your radar. So there may be a situation where this is review. That's okay. That's great. There may be situations where we talk about that's a little bit more advanced or down the road. That's okay too. I want to be able to have everyone in the audience find something that they can take away and say, we need to look into this a little bit more. If I can do that, that is a successful webinar, in my opinion. So how are we going to do that? We will just go through the business life cycle. There's a lot of you in the audience that are startups, and that will go through. We'll talk about entity formations. We'll talk about organizational documents. We'll get into the growth stage, which is talking about partnerships and equity. We'll talk about workers' classifications. We'll talk about IP considerations. And then we'll move into the maturity stage, just a little bit touching upon what are the 4 C's, legacy planning, exit planning. Again, I'm a little nitpicky, even though the business life cycle is technically 4 different buckets. If it was my decision, that and exit piece would be across the board. It would be a part of the startups, the growth phase, the maturity phase. We should always be thinking about an exit strategy. I'll get into that towards the end of the webinar. But let's go into it. And of course, you're talking to an attorney, so you know that this is coming. This is just for educational purposes. by you listening to the webinar does not create an attorney-client relationship. I know, I apologize, that is not the case though. So just keep that in mind. We are trying to provide as much information as possible that you can then take, whether you already have an attorney, that's great, or if you need to go seek one out, even better. So please, this is just educational purposes only, but let's dive into it. And the first piece is, well, the entity formations. And there's a lot of different types of entities that we can talk about. But I want to focus on three main ones. So if you are a entrepreneur, maybe having a side hustle, you don't file anything with the state and you just start selling widgets. You're a sole proprietor. You don't have to file anything with the state. Here's the issue with that. If you are a sole proprietor, you have unlimited liability. So in a perfect world where no liabilities exist, sure, sole proprietor may make sense for you, but that's not the case, especially in the world we live in today where everyone is looking for a quick buck and trying to sue for every little thing under the sun. As a sole proprietor, if your widget causes damage, hurts someone, injures someone, is just defective, and this isn't just widget related, it could be professional services as well. It's not just what you have carved out for your business that could be on the table. This is potentially all of your personal assets are on the table. So I highly encourage you, if you're on the fence right now and you are, again, using that example, selling widgets, you really need to consider, is sole proprietor really the best option for you? I would probably lean, probably not. Moving forward into the corporation space, because that's been around quite a bit. That's you filing in articles of incorporation. And what you hear often is this idea of the double taxation issue. Now, what in the world is that? That just means if your entity has created profits, it will be taxed at the entity level, as well as if that corporation then distributes or provides any distributions for the shareholders, then it's also going to be taxed at your personal level. So there goes the double taxation piece. Now, where you see this becoming popular, the corporation side of it, is where you want to bring in outside investments. Investors, not all the time, but prefer the corporate structure. Why? Because you can get very flexible in preferred shares. I use that as the example in my list. But they can then have preferred distributions, as I mentioned, preferred shares. You can talk about having the issued or outstanding shares, bringing on additional investors, other rounds of funding. That all leans towards the corporate side of things. And I mentioned retained earnings there, meaning if you were to keep and not provide any distributions, it would only be taxed at that corporate rate. End all, there are a lot of tax implications here. You can get very creative. We sat down with clients in the past and really got into the weeds of which pathway is the best for them. But at a high level, what you see a lot of times is the corporate route is much more common when you start bringing in outside investments or if you're going to do funding rounds. What has taken the world by storm is the LLCs. You hear it all the time. That's filing in articles of organization with the state. And what you hear is it's a pass-through entity, meaning that the profits don't get taxed at the entity level. They get passed through. If you're a solopreneur, it's on your personal tax or tax as a partnership, but it's still passed through to the owners of the company. And that's very nice because you still have that flexibility of you can carve out particular ownership units and still have multiple owners. You can still do that. There's a little less cost involved for an LLC. There's a little less compliance requirements for an LLC. These are all elements that, again, if you're a solopreneur, have a family business, have no real need at the moment to raise funds or outside capital, the LLC is checking a lot of your boxes. So that's what you see. Again, it's at a high level. I don't want to spend too much time on it, but I do want to highlight one piece, and that's the S Corp, the S Corporation. Now, the S itself just refers to subchapter S in the Internal Revenue Code. But what's important here, and it's a common mistake or a common misstatement, that the S Corporation is a legal entity. That's not actually true. It's not a legal entity. It's a tax status. So you can be an LLC, take that Form 2553, go to the IRS and say, please treat me or tax my entity as an S Corporation. You're still an LLC. Now, why is that important? Because there are potential tax benefits by going through and electing to be taxed as an S Corporation. You still get the benefit of that pass-through taxation that you can have with an LLC. But what's nice is you can now divide the income of the business from salary to distributions. That's a big difference, because if you structure it that way, there is the pathway for those distributions to not be subject to self-employment tax. Again, I don't want to get too far into the weeds, but that can be an enormous tax benefit if you're avoiding 15.3% at the federal level. So something to consider. Again, I just wanted to highlight that's not a legal entity. We've had clients come in all of the time that talk about, I need to convert into a corporation because I want the S election. That's not true. That's not true. It's just a tax status. The last takeaway that I would like to make on this slide itself is no matter what entity you choose, please, please, please do not commingle funds. I'm sure you've already heard of that, but if you create a separate entity for your business, make sure business expenses come out of the business account and personal expenses come out of your personal account. Why? Because there's a little legal jargon called piercing the corporate veil. And if you treat your entity like your personal piggy bank, then the court's just going to throw away the idea that this is a separate entity. Because if you're not treating it like a separate entity, why should they? And the outcome, your personal assets are back on the table. So if you're commingling funds now or being a little loose when you go to the grocery store, stop it. Make sure just transfer money from the business account to your personal account. And once you do that, then you'd be able to move forward. Now, I just want to make sure, I want to zoom out, make sure my audio is working. Okay, perfect. Let me go back. Now that the entity formation piece is complete, let's move forward and let's start talking about the organizational documents. Now, this is incredibly important. Once you form your entity, and I'm going to focus on the LLCs here for a moment. Once you form your entity, you need to document how is it going to operate. And your operating agreement is essentially the rule book for your entity. And specifically, it's going to cover who owns what, who's making the decisions, how are the profits split. It's going to cover all of those aspects. But most importantly, what I want to cover here is it plans for the 5 Ds of business, or at least it should, or reference another document called a buy-sell agreement that will accomplish this. It can be found in either direction. So what are the 5 Ds of business? It's like the what if scenarios. What happens if there's a divorce or a disagreement or a disability, distress, or death of one of the partners? How are we going to handle it? And we have clients that come in all the time, rose-colored glasses, which is great. We want our entrepreneurs to see the opportunities and the pathways forward and be excited about the future. But we need to be prepared. And they don't like thinking about the 5 Ds of business because it's almost as though we're raining on their parade. So use the attorneys as your excuse. Sit down and say, look, I understand we're never going to disagree. I hear that all the time. We're not going to deal with the buy-sell agreement because my friend and I, my business partner and I, we will never disagree. We're best friends, and that will never change. I'm telling you that's not going to happen. And that's not being a pessimist. That's just being a realist. You're going to run into situations where there is a high stress scenario and you may not agree. So you may be best friends, but these situations do occur. And I want to give an example because I think cases that we've worked on will be extremely helpful for this webinar. We've had a client come in and they planned for the five Ds. So much so that the company got life insurance policies on the two owners. And that was incredibly exciting. Until I learned they let those policies lapse. And those policies were phenomenal. They were young, they were healthy, the premiums weren't high, so they got a much higher life insurance policy than they needed. It wasn't tied to the business. It wasn't tied to the profits of the business. It was just, hey, we can afford this, and these are great, great benefits at low premiums. Let's get it. When they let it lapse, it's Murphy's Law. What can go wrong will. The business owner, the other business owner, had an illness, cancer, and passed away. And now we're stuck with what was two business owners, two different revenue streams for the business because they dealt with different services. 50% of the business was gone. And we had families that were so close that our client actually spoke at his business partner's funeral. That's how close they were. And everything fell apart. We're talking the surviving family was expecting that money that wasn't there. Whose fault is that? Where do we point the blame? We had the surviving family thinking that that money tied exactly to how much the business was actually making. That's not true. It wasn't even close. So they were demanding this astronomical figure to get out of the business. We didn't have it. The business didn't have it. And we had to fight tooth and nail for 18 months, putting the company at the brink of closure just to be able to buy out his deceased business partner's ownership share. And in all of that fighting and bickering, it's so easy to lose sight of what actually matters. At the time, his best friend had passed away, and now their kids who grew up together never talk. Their spouses who were best friends never talk. There's finger pointing. There's a lot of allegations out there that there was money that was being hidden, despite the fact that there was emails, texts, refuting all of that. It was a terrible situation that could have been avoided. They were there, they had it, and they let it slip through their fingers because they didn't stay on top of their organizational documents. So the big takeaway for this slide truly is, please don't treat your organizational documents as this filler, check the box, let it sit on the shelf and collect dust scenario. They should be reviewed at least annually. I know that doesn't happen. Maybe I have the rose-colored glasses on for that one. But they should be reviewed regularly and make sure it's actually checking the boxes that you need. So if you have any questions on that, please reach out. Highly, highly recommend. Please, if you don't have those documents on hand and have them drafted, blame the attorney. Say the attorney's making us sit down and work through these what-if scenarios. You're going to appreciate it down the road when something happens. Okay, let's get into a fun topic, partnerships and equity. Now, when I talk to clients that come in the door, a lot of times we'll hear, this is great, I'm 100% owner, I want to bring in a business partner. Please draft up documents. I want to give this person 25% of my business and everything's going to be phenomenal. And they get annoyed because my first question is, why? Why are you giving this person 25%? Talk me through it. It may make sense, but I would not be a good legal counsel and strategic advisor if I don't ask that question. And that's where this first column comes into play, these key considerations. And I always say, look, ownership should be earned, not gifted. And we'll run through these questions. Do you need a long-term partner, or are you just in a situation right now and you need help and you can't find any other way other than giving away some of your business? If someone's buying in, what's the value is that person bringing to the table? And for how long? Again, is this a situation where you're simply just bringing someone on and they're fixing maybe a Band-Aid? Or is there true long-term value that you can extrapolate and grow from? Can their contribution be measured? What if they went out? We've seen a situation. I gave this person 10% of my company. Day 2, they're gone. What happens? And worse, as I mentioned in this bulleted list, what if they never leave? Someone has 10% of your company, and there's nothing that says in the organizational documents that you can force them out. What now? Can't unilaterally kick them out unless you have some judicial interference, but how do you do this? Do you have a strategy to back out if that day ever comes? And again, a lot of times, that initial conversation, that question can't be answered because they don't know. I haven't thought about that. And the reason for that, it's just a glass half empty mentality. I get that. But these are things that you should think about. And the last question that I ask is, do you want to share control or just the profits? And a lot of times when we run through those questions, not all of them can be answered. And that shifts our conversation to the alternatives, because there are ways that you can reward without giving away the business. So if you have, let's say, employees, you can have bonuses tied to performance. You can have higher commission structures, the better that they do. A lot of times, especially for employees, they love the idea of ownership, but really what they want is the financial benefits. They don't want the late nights, the sleepless nights, the stress, everything that you're putting in, the blood, sweat, and tears. They don't want any of that. What they truly want, I'd like the bigger paycheck at the end of the day or at the end of the year. So we can go into, maybe it's a revenue sharing agreement or a profit sharing agreement that allows you to maintain full control. One thing that we've talked about in the past with clients is phantom equity. And what does that mean? So phantom equity means what it kind of talks about. Phantom, you're not actually giving away percentage of the company, but really what individuals want is, look, I'm helping you build your business, and I want to realize a windfall down the road if a triggering event occurs, i.e. a sale. If I help you build this company, I want to have 10% of phantom equity. So if we net $1 million, let's just use that, easy numbers, net $1 million from a sale, then my 10%, I want to get $100,000 from that sale. Again, I don't want to deal with the headaches that come with owning a business. I'll let you deal with that, and you can maintain full control and decision-making powers. And we'll get into why this matters in just a moment. And ultimately, you can get into the future equity. So if you know this is inevitable, have it tied to a vesting schedule. What are the parameters? What are the metrics? What I talked about. Maybe their contribution can be measured somehow, hitting some KPIs, but have it vest over time. That's very important. Now, let me get into the real life situations, because this is important. It is very interesting. And I have there, what's done can't always be undone. I had an old boss that would tell me when I was working as an accountant, anytime there was a mix-up or an issue or an error, he would always say, are we able to unscramble the frittata? I hated that line, because I knew going into even important meetings with executive level sitting there, he's going to raise that question if there is an issue out there. And for some reason that stuck with me, but I can't succumb to saying that all the time. What's done can't always be undone. That's what I'll go with. But let me give you 3 examples. The enthusiastic founder. When I first switched over to the legal industry, I had a client who was just starting out, phenomenally intelligent individual. And he was so excited that his side hustle turned into he was able to leave his business. And he was able to not only provide for himself and his family, but now he was hiring people, and he was through the roof, excited that he's now helping other families provide for themselves. That's an intoxicating feeling, especially for an entrepreneur. Well, he let that get the best of him because that enthusiasm and the growth and the extreme growth that they were seeing, he was giving away. It was like Oprah, you get a share, you get a share, you get a share. And at the end of the day, we were sitting there and I kept asking him, please, please stop. Please stop giving away the company, because there's going to be a time where you may want to exit or expand. And all of these small percentages, even though he maintained control, that's going to be a headache down the road. And sure enough, or down the road, and sure enough, it was. Just this past year, he sold the company, and it was low 8 figures. So it was a substantial sale. I'm still incredibly proud of seeing that progress through the history of the company. But I can tell you, it was an absolute nightmare cutting checks for people that have since left the company. That enthusiasm that they felt wasn't the same as the owner and the founder. And they left the company, they kept their shares, and they got an absolute windfall at the end when he sold the company. So just be careful. I'm not saying that you need to hoard ownership percentages if you want to be able to bring in individuals who are trying to grow this to the next level. I'm not saying that. I'm just saying be careful. The second one is the tie-breaking nightmare. And it truly was a nightmare, and it was incredibly sad. We had clients, 50-50 owners of a business. They finally wanted to bring someone on as a CEO or executive level so they could pull themselves out of the business. The line, hey, you should be working on the business, not in it. They were there. They were at that point in their life. And they brought in an executive level, and they had a vesting schedule in that second column there. So that's great. But what they allowed was less than 1%. And we'll use it for this example, but it was less than 1% that vested right away. And they didn't update the operating agreement. They didn't do anything. So what you typically see is, unless there is something else that is specifically stated in those agreements, majority rules. Sure enough, business partners that were 50-50, let's call them 49.5 and 49.5, never saw eye to eye. Complete falling out. They couldn't agree if it was day or night outside. And they were finger pointing the whole time. Well, this 1% business owner, this 1% executive level, was the swing vote on everything. And he knew it. He knew it. So his leverage was bar none. And you may be sitting there thinking, well, why don't you just buy him out? We did ultimately, but you can best believe that they paid an astronomical premium to get that individual out because it didn't work out. The executive level, once, for a multitude of reasons, had to leave the company. Couldn't stay with the company anymore. Well, guess what? You still have 1% that vested. And that person was not going to relinquish that right because he knew that he was essentially able to run the company. So please consider that as well. Even giving that small percentage could be make or break if you're not updating those organizational documents. Last comment I'll make on this, and then we'll move on from this slide, is what's called the financing trap. We had a client, had business partners, multiple people. A lot of times when you're talking about let's use the SBA. Any owner that's over 20% most likely needs to provide a personal guarantee. Well, this client decided, this is great, everybody's happy, we'll use our home as collateral. Inherently, there are some issues with that. One being, there was a falling out. You see the theme? If I haven't scared you enough, maybe that's not the intent here. But there was a falling out between the business partners. And unless we could find a way to find a third-party buyer or have the other business partner go through underwriting to try to remove the collateral, our clients were stuck. Their home was still going to be tied to this business. And that is a scary thought, that you want out. You don't want anything to do with your business partner and soon to be former business partners, but your primary residence is tied to the SBA loan. That is scary. That's a scary place to live. And to make matters worse, they wanted to sell their property and they're stuck. They couldn't. Think about over the past handful of years, how hot the market has been. They couldn't join. They couldn't be a part of it. So that's another thing just to be cognizant of and weary of as you move forward. So again, takeaway, please don't give away equity casually. It is worthwhile to have a very serious conversation and make sure you're getting your money's worth. You're putting a lot of time, effort, and like I said, sleepless nights into your business. Don't just give that away. Make people earn it and be cautious how you grow. Okay, let's move on to the next. And this is worker classifications. This is a hot button issue right now. We're moving into the growth phase now. Sometimes we have a lot of clients that come in, they started the business, owner and operator. Now they come to us and say, we want to bring on some workers. And herein lies the big question. Are they a 1099 independent contractor or are they a W-2 employee? The government cares mightily. And we have a ton of clients that come in and they say, it's okay, we shook on it. This person is a 1099. They agreed to it, I agreed to it, we're good. That is not the case. I know it's not on TV anymore, but I've always been a fan of The Office. So for any of those who like it, you'll know what reference I'm about to make. If you don't, the main character in The Office was going through some financial troubles, and they told him he needed to declare bankruptcy. So what did he do? He just declared it. He just went out and said, I declare bankruptcy, just because you say it's not true. Same thing here. Just because you want someone to be a 1099 independent contractor doesn't make it so. So what do we need to be cognizant of, and what do we need to be thinking through? And I brought out some elements here to think about. And there's no one element that is determinative. This is going to be a balancing act. So let's walk through these here. First is that opportunity for profit and loss. So what in the world is that? That just means if you're bringing someone on, a worker on, and they maybe are subcontracting themselves, maybe they're bidding the work, and there is an opportunity. Look, if they price it too low, they may be taking a loss on the project. Okay, well, that sounds a lot like an independent contractor. But if you're telling me that your worker gets a salary no matter what, and no matter the project or success of the project, that leans more towards they're probably should be classified as an employee. And let's go through the rest of these. Investments by the worker, what does that mean? Are they providing their own equipment? Are they buying their own equipment? Or are you providing the equipment for them? Again, if they're providing their own, that leans more towards a contractor. If you're providing it for them, employee. This third one, degree of permanence, we see this one quite a bit. We have clients who will have contractors, and I ask, how are you paying them? What is it tied to? And they don't have an answer for that other than, oh no, they're just coming in and they're working for me 30, 40 hours a week, and I pay them biweekly in accordance with our normal payroll practices. That leans more towards you have an employee, not a contractor. On the flip side, if it is project-based, look, we have a plumber. We need him to come in and do all the plumbing work on this project. After the project, we may use him again, but we may not. and he'll bid out that project for if anything else comes in. Okay, that's contractor. Nature and degree of control. This is a big one. How are they, what's their freedom in performing the services for your company? Are they free to do and choose? Are they free to choose how they perform those services? Or are you laying out the groundwork? Meaning, are you requiring them to be in office 9 to 5? You need to sit in our meetings. You need to be providing us daily reports. That sounds like an employee to me. Or are you saying, look, we need to get this project done by next Tuesday. Can you do it? Yes. Okay, great. And then that contractor is free to perform those services in any which way that they please. Again, still needs to be to your satisfaction or the end client's satisfaction. I get that. But if they have that freedom of how, when, and where to provide those services, that's more contractor based. These last two, let's go through them quickly. Extent to which the work is integral to the business. This is simply saying, if you are a marketing company and you hire, let's use the plumber again, that's not integral. That is more aligned to a contractor. On the flip side, if you are that marketing company and you hire a social media manager, again, perhaps 30 hours a week, that's going to lean more towards the employer side or the employee side. And finally, that skill and initiative. Look, if you're going to hire an independent contractor, it's because they have a particular skill set. If you're telling me you have hired someone and they have no specialized skill, you just are going to be supervising them and providing them direction on how to complete their tasks, it sounds like an employee. So again, this has been a very hot button issue. We have dealt with, it seems like few and far between several years ago of audits. It seems like we're getting hit with them on a constant basis. New clients are coming in and saying, I'm being audited. We had one where they had 60 independent contractors or perceived independent contractors. And our client was telling them where to be, telling them their schedule, and going through, they had to submit reports. Look, very rarely do I admit defeat, but we were in damage control on that one, finding any way that we could limit our exposure. And it was a negotiation process. We were going to be owing some penalties and back taxes. That was inevitable. We were trying to limit them as much as possible. So please keep that in mind. It can be very, very costly. Okay, let's move right along to intellectual property. And specifically, I want to talk about trademarks for a second. So when we talk about intellectual property and trademarks, we're talking about your brand. And your brand is truly an extension of your company's identity. We're talking about business name, logo, slogan, product names. If I were to show you the Nike swoosh, without saying Nike, of course, if I was to show you their logo, you would know, 99% of you would know what company that was. Similarly, if I were to tell you what company's name or slogan is just do it, again, that's Nike. It's very common. That is their brand. That is their identity. When we talk about startups, we've had clients who had absolutely no idea or interest in any type of trademarks. And we've had clients who don't even have a business yet, but they say, I know I want to trademark this. I want to protect myself, my brand, and everyone in between. And that truly is what this is all about. It is preventing competitors from being able to utilize and use similar names as yours. It's putting the world on notice that this is your mark, this is your brand, this is your identity, and you intend to protect it. And that builds value. That is a business asset. Your intellectual property is a business asset. And it gives you enforceable rights in addition to just common law rights, but it gives you enforceable rights to protect your marks, your trademarks. And what you'll see, just as a fun fact, this is an aside, when you go out into the world, look for that little TM that you see beside a slogan or a logo, that little TM means that they submitted an application and it's pending. It's under review. In contrast, when you see that R with the little circle around it, that's a registered mark. So fun fact, if you don't know that, that's where those come from. Now, why is this important? The USPTO, the United States Patent and Trademark Office, they have 45 different classes that are out there. So when you submit an application, you have to tell them, what class do you fit into? What are you trying to protect against? Maybe it's clothing. Maybe it is in the tech space or in the tech sector. But you need to be able to provide to them what area are you trying to prevent competitors from coming in and stealing your marks? And why is that important? Let's use the example of Dove. There's Dove soap and there's Dove chocolate. Both are trademarked, but both can coexist. Why? Because no one's biting into a bar of soap. Well, maybe if you're a child and are in trouble, but no one's biting into a bar of soap and saying, now, wait a minute, I thought this was chocolate. Because they're in different classes. And that's what the USPTO tries to do. People can coexist with similar marks. Dove, great example. But they're totally different businesses and totally different classes. So it's something to think about. It's not necessarily the easiest and self-explanatory process to go through. So I encourage you to at least get an advisor or an attorney involved in the process. And what I have here on this screen is something that's interesting, because what I tell clients when I help them with their IP or their trademarks, it's a hurry up and wait process. Look, get us this information. We want to fill out the application and get in line, save our place in line. But look at this. The USPTO's first action, your application won't get assigned to someone for 6 months. And I can tell you, the USPTO is getting better. That used to be 8 and 9 months. The total process from start of the application to having a registered mark takes almost 12 and a half months. And that's pending that there's not going to be any significant issues and hurdles that you have to get through. So it is a long process, and you have to endure some of the length and time there. So that's why it's important when I work with clients, get us the information, let's get in line. So that's a little bit about trademarks. Why is that important? I just very quickly, in terms of a case study, is we've worked with a client, mom and pop shop. They had a particular name. They were working they barely had an online presence. A software company had the same name in California. Arguably, they were in different classes. That's the arguments that we made. They didn't care. They were so happy. They made a ton of threats, which, quite candidly, I didn't appreciate, because they scared the hell out of our clients. They didn't want to get caught up in a lawsuit that would cost tens of thousands of dollars. They didn't want to do that. And I had to talk to them saying, look, you're in the right. However, that's not going to stop someone who's litigious from filing a claim against you. So they said at the end of the day, look, we should have looked into it more. We understand. What can we do? So we negotiated a buyout. The software company was fine. They said, look, we're not going to offer you a lot. You're a mom and pop shop. This is what we're going to do. This is our offer. And we ultimately negotiated, but took it. But here's the problem, and this may be applicable to your company. Rebranding costs a lot of money in and of itself. You may have flyers and on a website that you paid for already, email addresses, social media accounts. You've done so much work to create this brand, and all of a sudden, a lawsuit or a threat of a lawsuit comes and it forces you to do a complete rebrand. So please think about that IP aspect of it. Okay, let's move on into exit planning. Now, again, I started off this webinar with the idea of my personal belief, exit planning is just good business strategy across the board. I don't care if you're just starting up in the growth stage or a mature company. You should always be thinking about this. Why? Because it's just good business strategy. And that's not to tell you that you should be ready to sell tomorrow. That is not the game plan. Instead, what I'm talking about is you need to be ready. And that's just personal readiness. And again, I'm not talking about you need to be ready to sell. I'm talking about, do you know what you would need upon a sale? Do you know what your next steps are? Would it be starting up another business? Would it be going on a lot of travel and vacation and spending time with the family? What does that look like? How much money would you need? What does that look like? So that idea of personal readiness is one aspect. But another, which is what we're going to focus on here, is while you may be ready, if and when that day ever comes that someone knocks on the door and says, hey, are you thinking about selling your business? Your business has to be attractive as well, which means, are you building something that is worth buying? And again, I get it. This may not be even on the radar for some people who are just starting out, but I encourage you to always think about this. Are you building something that's worth buying? Buyers are looking for predictability just as much as they're looking for profitability. And when we're talking about how you can best package your business and how attractive your business can be, this is where the 4 C's come in. So if it was unclear from that initial slide about what is the 4 C's, this is what I'm talking about here. So what are they? First is that human capital. What's the value of the talents that you have in your company? More specifically, when I have clients come in and talk about, hey, I'm thinking about selling maybe 3-5 years down the road, I say, great. Who's answering the questions? If I had questions about the business, who am I talking to? A lot of times they're saying, well, me, I have those answers. I'm the only one who knows about this particular process, or I'm the only one that knows how we handle these situations. That's not great. We want to be able to have a team that could run without you. Because if you're the only one, if you're the most important person in the room, that's going to be an issue for a prospective buyer because they're buying you out. That transition plan may only be, let's say, 30 days, and then you're on a cruise and you're gone. And they're stuck with a team that has no idea what to do. So consider that. Second is the customer capital. Again, talking about the relationship of your customers. When we talk about customers, who are they loyal to? Are they loyal to you? Or are they loyal to your sales team and what you're building, to the company? Again, we've had clients that have come to us and said, we don't trust people who want written contracts. I am a handshake type of guy. That's fine. Just recognize that that's going to be an issue down the road. Because when we talked about buyers want predictability, it may be great that you have a customer that's been around for decades. But if you're looking at a situation where it's on a handshake deal and that customer could leave tomorrow or 2 years from now, that variability will affect a proposed purchase price. Moving forward into that structural capital, we're talking about processes, SOPs. How are you handling on the back end of things? A great example that I give clients is I used to have a PCP that I've moved on since. When I walked in and I wanted to schedule my next appointment, they brought out this huge book and they opened it up and they said, okay, and dust was flying from this book. When do you want to schedule your appointment? And they went out 6 months and I couldn't believe it. I said, wait a minute, you don't have software that will handle scheduling, simple scheduling. And they said, no, this is how we've always done it. He just likes it this way. I can promise you, I walked out of there. I found a new PCP because I can't trust, if you are that, in my opinion, disorganized and don't see the value. And I'm not saying all tech is good tech. Believe me, I'm not saying that. But if you can't find the value in simple SOPs, I lost trust in that PCP. Buyers are going to lose trust in you if you don't have something built out and see that you are behind the times. Because what I can tell you is tech continues to get better and faster and more innovative. So think about that structural capital. The last one is social capital. And my argument would be is this is driving the other three. It's your culture. It's your brand. It's your reputation. It's your goodwill. Goodwill is something that those intangibles drive the purchase price. And what I can tell you is if a buyer comes in and does a walkthrough and everyone is miserable to come into work every single day, again, that affects the purchase price. So these are all things that you should be thinking about as you go through. And I know we mentioned in that initial slide, we talk about legacy planning. I'll just touch on that a little bit. And that truly is, I don't like the idea of calling something an estate plan. People don't like thinking about end of life and their mortality. But when you start to rephrasing it into a legacy plan, okay, now what are we talking about? It's preserving your legacy. What happens to your company if something happens to you? One example we give clients all the time. If you get hit by a bus, who's running payroll? How are your employees getting paid? Who has the power of attorney to do that? Because it's going to get caught up, and there's certain industries out there that if payroll doesn't get run once or twice, that company ceases to exist. And now there's no buyer out there who's going to want your entity or your business that you've created and worked so hard to create. So at a minimum, please, a simple estate plan involves your last will and testament, involves your living will, involves your power of attorneys. And I'm talking about your durable power of attorney, what happens if, those financial aspects, and your healthcare power of attorney. Incredibly important that you have that in place. You should do it for your company. You should do it for your family, especially I have a lot of business owner clients who are just starting up and they have young families. Please don't do yourself a disservice and them a disservice by not having anything in place, a contingency plan in place. Okay, so we have, I think, about 8 minutes or so left, not a ton of time. What I have done is first and foremost, yes, absolutely, thank you. I want to be able to hear from you, get feedback from you. Was this helpful? What worked? What didn't work? That feedback will help me. And like I said, will help future. We've done these presentations a lot over the years. We want to refine it. So please, I am not beyond begging. Let me hear your feedback. Shoot me an email. I'd love to hear it. But I have about time maybe for 2 or 3 questions. I've looked at prior webinars. There wasn't much back and forth with the audience. So knowing that, I pivoted a little bit. I have common questions here that I'm just going to touch upon. If you have a particular question, please reach out. I would be more than happy to jump on a call and talk through a particular issue. That's no problem at all. But knowing that, I'll just dive into some high-level questions that we've seen in the past. One is, do I need to have someone draft an operating agreement for me? I have a template that we got from all of those DIY websites. My statement to that is you get what you pay for. You need to understand the value of someone working and putting and customizing those documents for your business. I can promise you I've seen those DIY operating agreements and they are subpar because they're not customized. They don't address a lot of the issues that you need addressed in your business. Nothing is one size fits all. So you can, but you probably shouldn't. So that's one question we got a lot of in prior presentations. The second one that we get a lot of is, what's one thing I should revisit every year? So here at Koza Law, For our clients, we do what's called a business health check. But for everyone listening in, what I recommend, whether you're a corporation, sole proprietor, LLC, have at least an annual meeting. Sit down with you, with your spouse, if you're a solopreneur, with your business partners, and go through. It's a giant reset. What happened? Write it down. What happened that year? Did you run into issues, run into lawsuits, run into big projects? Did you buy equipment? Go over forward thinking. What are we going to do next year? Write that down and have everyone sign it. And the reason for that is because you're resetting the baseline. Everybody was in agreement. Everyone understood. No one can have revisionist history and try to change what we thought and what we said and what we agreed upon. Because when you sit down every year and talk through that, then you can, again, move forward with confidence. So I highly recommend those annual meetings as one thing that you can do every year and revisit every year. Let's see here. I have just a few minutes, so I'll do one more. What is the biggest legal mistake that you see business owners make early on? This one, honestly, is my favorite one. And what I would tell you and what I told this person is, you, again, going back to, you need to understand the value. You need to understand, invest the time to find advisors that fight for you. And this is perfect. That's why I jumped at the chance when SCORE asked me to do this presentation. Thank you again, all of the volunteers, all of the mentors out there with SCORE. This is phenomenal. But invest the time to find people that fight and are in your corner. There are people out there. There's subpar professionals everywhere you go. You have to put in the time to find the right ones. I'm talking about insurance reps, CPAs. I'm talking about wealth managers or financial managers, SCORE, obviously, and attorneys. We're not immune to this. And they should all be working together in your best interest. I promise you, people have sour taste in their mouth and say, I never want another insurance rep in my life. But I can promise, when you find the good ones that fight are in your corner, you can call them and they'll pick up their phone and they'll say, absolutely, I got you. You need to be thinking about this, this, and this. Go talk to this person. I'm going to send you over here so you can talk to them. It is without a doubt something that you can extrapolate and build a solid foundation for your business much quicker than trying to DIY it. If you try to go alone and try to figure all of this out by yourself, that is not only a lonely perspective, but it's not sustainable. You will burn yourself out very quickly. And just touching upon that attorney piece, we run into situations time and time again. Clients come in and say, I have a friend of a friend who's helping me. They're an attorney. They got it. What I would tell you is attorneys are not one size fits all, meaning you don't go to the podiatrist if you have a heart issue. You could have the best podiatrist in the world, and they would not be giving you great advice if you have a heart problem. The same thing goes for an attorney. You shouldn't be using a criminal law attorney who's a friend of a friend to help set up the foundation of your business and give you business advice of how to move forward. That sets yourself up for failure. Okay, we have only a couple minutes, maybe a minute left. I just want to thank everybody again. This has been an absolute pleasure. Please, again, reach out, send me an email. Was it helpful? Was it not? Believe me, I have thick skin. Give me those critiques. Love to hear from you. And thank you again from everyone at SCORE. This was a blast. Thanks, everybody.